Good afternoon, and welcome to the second part of Sensible Financial Planning's two-part webinar series on bonds. This is on TIPS, which are Treasury inflation protected securities. I'm Carrie Fristo, and I'll be your moderator. Today, Sensible Financial's founder, Rick Miller, will be speaking about TIPS and the inflation protection they offer. Rick holds a PhD in economics from the University of Chicago and started Sensible Financial 20 years ago. He is also a certified financial planner. You can register for upcoming webinars through a link in Sensible Financial's newsletter, which will be published later this month, or at www.sensiblefinancial.com/webinars. There will be a Q&A session. There will be two of them, actually. And please, if you have questions, submit them through the Q&A link at the bottom of your window. Rick will answer as many questions as he has time for, once approximately halfway through the webinar and once at the end. Unfortunately, he can't give personalized advice, but he can do, answer your general questions and questions about this topic. We'll provide contact information for Rick at the end of the webinar, and you'll receive a link. You'll get an email with a link to the recording after it's done. Thanks, and take it away, Rick.
Thanks, Carrie, and welcome. Today, we're going to talk about inflation and TIPS and the benefits that TIPS offer in protecting against inflation. We're going to start by looking at inflation that we're experiencing or have experienced, and then we will move on to talk about TIPS and how they can help. We'll start by looking at inflation since 2001, and we'll think about what a dollar bought then and what it buys now, or what it buys close to now. In 2001, a dollar bought what we would have thought of as a dollar's worth in that year. In 2011, a dollar bought only as much as 78 cents bought in 2001. That's a decline of 22% in 10 years. In 2021, a dollar bought only as much as 64 cents bought in 2001. That's another 18% decline in another 10 years. Over those 20 years, from 2001 to 2021, the dollar bought less and less, a 36% decline overall. The math of declines is a little complicated. That's why 36% is different from 22% plus 18%. But I assure you, I've checked it several times, and the total is correct. So now let's look at a specific example of inflation in a particular component of the consumer price index. Let's look at the price of ground beef. And looking at it over a slightly longer period, looking at it from January of 2001 to April of 2021. And ground beef's an excellent intuitive example, or at least I think it is, because everybody or almost everybody buys hamburger or hamburgers. And it's clear, or from the graphic above, and then if we look at the numbers, that your dollar buys a lot less hamburger today than it did in 2001. Ground beef prices have risen from about $1.70 a pound in January of 2001 to $4.92 a pound in April of 2022. That's an increase of 190%. Alternatively, a dollar buys about 3¼ ounces of hamburger today versus about 9.4 ounces in 2001. That's about a third as much today as it did 20 years ago. So that's a practical example of what inflation means. And I'm sure you're seeing it at the grocery store or in other places where you shop. Now, inflation has been controlled since about 1985 or so. You can see here that inflation was pretty low, mostly below 5%. And above 0% throughout that period. And in contrast to much bigger fluctuations in inflation earlier on, say around the time of World War I, and this is a big deflation that occurred around the time of the Great Depression, and then lots of inflation here after World War II. And then there was a lot of inflation in the 80s, 70s and 80s. But since then, not so much, until the COVID crisis and the inflation that's followed. Now, I think that a lot of people thought that economists in the Federal Reserve had figured out how to manage inflation, but we've seen very recently that that confidence has been at best overstated. Now, let's look at the implications of inflation for bonds, and then we'll move from there for nominal bonds, and then we'll move from there to talk about tips. And we'll start with a simple bond. We're lending $1,000 for a year at 5%. And just to get our terms, the principal is what's called the principal. The amount lent is $1,000, and the borrower is going to repay that $1,000 plus 5% interest, or $1,050. So $1,000 in principal, $50 in interest, and that interest, $50 divided by the principal of $1,000, gives us an interest rate of 5%. So there's no inflation, the purchasing power of the dollar is preserved, you get full value for the interest, and all interest is in full value dollars. Now let's contrast that with the situation where there's 2% inflation. Same loan, we're again lending $1,000 for a year at 5%, but now inflation is 2%. And so we're going to look at the purchasing power of this 5% of interest on the $1,000 at the end of the year. So the borrower pays back $1,050, but that's $1,029.41 in purchasing power, because inflation has been 2%, the dollar buys 2% less. We take the $1,050 and divide it by $1.02, and we get $1,029.41. The real interest rate, the purchasing power interest rate, the increase in purchasing power that the lender receives is 2.9%, not 5%. And we could ask, is there a simple relation among nominal interest, real interest, and inflation? And in fact, there is. Quite simply, the real interest rate, that real purchasing power interest payment as a percentage of the loan balance, it can be approximated simply by starting with the nominal interest rate and subtracting inflation. So the nominal interest rate is 5%, inflation is 2%, and the real interest rate is 3%. Very close to the 2.9% that we saw before. It's an approximation, and it works very well with low levels of interest and low levels of inflation. Notice that if inflation rises, real interest rates fall if nominal rates don't adjust. So if inflation went, let's say, to 3% and the nominal interest rate didn't change, then the real interest rate would go down to 2% and so on. And I'm going to suggest that real interest rates are the ones that matter, because you spend purchasing power and you buy hamburger. You can't eat dollars. You can eat only hamburger or some other kind of food that you buy with dollars. And if dollars buy less food, then you can't eat as well or eat as much if your spending on food doesn't change. Now, what we're going to look at next is how you can preserve purchasing power in the face of inflation. And we're going to look at one particular mechanism or one particular method, which is TIPS, Treasury Inflation Protected Securities. And TIPS are Treasury bonds with a special feature, inflation protection. So when they're issued, they have a face amount, which we'll look at in a moment, a real interest rate, and we say here real, but the interest rate doesn't say on the little placard that we've taken from the Treasury website. It doesn't say that it's a real interest rate, but in fact it is. And then we have this sort of curious thing here, which is called the reference CPI on the dated date. And then finally, the security term, which is how long the bond is issued for. In this case, it's a 20-year bond. And this particular bond was issued on January 31st, 2006, and it will mature on January 15th, 2026. And you see that the dated date is January 15th of 2006. So 20 years from the dated date to the maturity date. Okay. Now, if you want information about the tips that from someplace other than here, the Treasury Direct website has lots of information about it. And now we're going to look at how tips work, and we're going to spend the rest of the webinar on that subject. And basically, tips work, although this is a kind of a busy slide, tips work very simply. Every day, the Treasury adjusts the face amount of the bond for inflation 3 months ago. So it looks back, it sees what inflation was 3 months ago, and it increases the face value of the bond to match. So if we look at it a little bit more closely at how that's done, the Bureau of Labor Statistics, the government, issues an estimate of inflation every month. And this year, in April, and I should say a little bit more about how they do that, while they report an inflation rate for April and for May in this case, they're calculating that inflation rate by looking at the consumer price index, which is a number, and they're looking at changes in that index. And the inflation rate is the rate of change in that index. In April 2022, the consumer price index was 289.109. And in May 2022, it was 292.296. And the Treasury adjusts the face amount of the bond, the tips, every tips, based on those numbers. So it takes, for all tips, the reference CPI or the reference consumer price index on the 1st of July, 2022 was the same as April's. And the reference CPI for August 1st, 2022 will be the same value as the CPI in May of 2022. And then they just draw a straight line between 289.109 and 292.296, and they spread that difference out over the 31 days of July. And they adjust the face value of each tips in that proportion. Now, each tips was not issued on the day that the consumer price index was 100. They were issued on different days. So what we're looking at for this particular tips, this 20-year tips issued in January of 2006, is what the CPI was on the day that they, or the dated date, right? The date that they are starting to count inflation. And that reference CPI was 198.477. So they divide the reference CPI by the reference CPI of the start date of that bond, and they get a ratio of 1.45. So the price index is 45.6% higher on July 1st, 2022 than it was on January 15th, 2006. So that $1,000 bond, is going to now have a face amount of 1.4566 times 1,000, or $1,456.63. And each day they adjust, the Treasury adjusts the face amount of each tips. The adjustment for each tips is going to be slightly different because its issue date CPI will be different, but they're all going to be based on the reference CPI produced by the Bureau of Labor Statistics. And you notice that the face amount or the adjusted principal for this TIPS changes every day, and it's different on July 15th than it is on July 1st, and it's different still on the 23rd, and it's even more different on the 1st of August. But it's in proportion to the change in the reference CPI. So if we well, we're going to look and see if the bonds were issued with little LED chips on them that showed what the adjusted principal was, it would change every day, and it would show these numbers on these dates. So we can already predict with great confidence what the face amounts of face values of that particular TIPS will be on these days, because the Treasury has told us. Now, TIPS or bonds, they pay interest, and they pay interest every 6 months, like most Treasury bonds. And those interest payments are 1/2 the interest rate times, but in this case, not times the original face amount, which is 1,000, but times the adjusted principal, which we've seen ranges between 1,456 and 1,472. We're particularly interested in the face amount on the 15th of July, because that's when this particular TIPS pays semi-annual interest. Remember that the dated date is January 15th, and the maturity date is also January 15th, and these bonds pay interest every 6 months. So July being 6 months after January, there will be an interest payment on this bond on July 15th of 2022, and the payment will be based on the interest rate. You may remember it was 2%. Since it's paid every 6 months or twice a year, half the interest is paid, in this case in July, the other half is paid in January. So we start with that 2%, we multiply by 1/2 to get 1%, we multiply it by the adjusted principal of $1,463.89, and we get $14.64. That's the interest payment that would be made on this TIPS on July 15th. Now, if this were a standard Treasury bond, a 20-year Treasury bond, let's say, that was issued on the same date, if it had the same 2% interest rate, the interest payment would be $10, not $14.64. So already you can see that there is some inflation protection benefit to the TIPS. And the purchasing power of the interest payment is preserved, because $10 in 2006 is worth $14.64 today. So while the standard Treasury bond, you'd be losing purchasing power in the interest payment, you'd be preserving it with the TIPS. Now, you might ask, what happens if there's deflation? What happens if the price level goes down? What happens to TIPS in that case? And it works just the same way. The adjustment to the face amount of the bond works just in the same way. If there's deflation, the CPI would go down, and the face amount would also go down, calculated in exactly the same way. The adjusted principal for TIPS would go down, but the purchasing power would be preserved. So the value in dollars of the issue date would be maintained. And there's a little benefit here associated with TIPS, in that at maturity, the TIPS owners receive the greater of the adjusted principal and the initial principal. So suppose there was a lot of deflation, and the adjusted face amount on the bond was $900 instead of the issue of 1,000, the purchaser or the owner of the bond at that point would receive 1,000, which was the original face amount. And in that case, your purchasing power may actually increase if there is deflation. Okay, so Carrie, those are the basics. Let's see if we have any questions.
Yes, we do. Okay, Stephen asks, are TIPS a good alternative for bonds in one's IRA portfolio?
I would say yes, they are. TIPS, first of all, are bonds. They are Treasury bonds. So I want to say that again. TIPS are Treasury bonds. They're supported by the full faith and credit of the US government, just the way standard Treasury bonds are. And they, as I say, offer this additional benefit of inflation protection. And we'll see in the second part of the webinar that they are especially good at protecting against unexpected inflation, unpredicted inflation. And we'll also see that the tax treatment of TIPS makes it likely more beneficial to hold them in retirement accounts than in taxable accounts. That doesn't mean that it's not beneficial to hold them in taxable accounts, but just that it's more beneficial to hold them in retirement accounts, tax qualified accounts.
Okay, let's see. He also asks, can or should TIPS be purchased within mutual funds?
Well, we're going to talk a lot about TIPS and about how they are priced and about understanding their value and so forth. And I think people will see that they are somewhat complicated in terms of how they're priced and how they're valued. And buying them through a mutual fund or with a professional advisor will allow you to rely on the mutual fund or the advisor to both understand the pricing and also to help you with any taxes that are associated with them. And I think that's likely to be an advantage. There are some benefits to buying individual TIPS, and we're not going to talk about those today. But basically, the advantage of the individual TIPS is that you can what's called asset liability match the maturity of the TIPS with spending that you intend to do in a particular year. And so you can inflation protect and also insulate yourself from interest rate movements if you do that, if you buy individual TIPS. But that's a sort of a specialized application.
Okay. Peter the Great asks, are Vanguard TIPS different from US government TIPS?
Well, I'm going to go out on a limb here, and I'm going to suggest that there's no such thing as Vanguard TIPS. There may be a Vanguard TIPS mutual fund, but that Vanguard TIPS mutual fund is investing in US inflation protected bonds, Treasury inflation protected bonds. There are, I believe, or at least there used to be, I haven't looked in a while, there are inflation protected securities issued by other governments, but by non-US governments, but we're not talking about those here. And we're going to devote all of our discussion today to US TIPS, but there's no, just as there aren't Vanguard Apple shares or Vanguard Facebook or Meta shares, there aren't Vanguard TIPS. The TIPS are issued by the US government.
Jeff asks, if one has tons of money, why would he or she not put all of their money in TIPS?
Well, whether or not one had tons of money, I think first of all that it's worth recognizing that TIPS are US Treasury securities. They are not agency securities, they're not corporate bonds, they're not mortgage-backed bonds. So they're not diversified in that sense. They are very low risk, and if one is seeking a very low risk inflation protected asset, TIPS are great for that. If that was your choice, if you intended to have all of your assets in low risk inflation protected assets, then TIPS would be the best way to go. But many people are interested in having the opportunity for return in excess of the returns that the lowest risk assets offer. So many people would have money in stocks. Many people are looking for the higher returns, at least in nominal terms, that corporate bonds might offer, and getting exposure to more sources of potential return. And TIPS are providing just very low risk interest exposure. And so if that's what you want, they're your vehicle. But if you want other sources of return, then you need other vehicles.
Okay. What if you don't hold until the maturity date? And also this person wants to know, what is the shortest maturity date? Are they all 20 years, or, you know, are there shorter ones?
Okay, so there are two questions. Let me take the second one first, and then I will come back and ask you to repeat the first part. TIPS are issued at 30-year maturities, at 10-year maturities, and the Treasury is constantly trying to decide how much of each maturity they're going to offer, both in TIPS and in standard Treasuries, because they're managing the debt of the federal government. And so there's sort of no standard plan. Sometimes they will reissue TIPS, so they might, after 10 years after the issue date of a 30-year TIPS, they might reopen the offer, and then you could buy those TIPS, but at that point they'd only be 20-year TIPS, because only 20 years is left. And then in another 10 years, they might reopen it and you could buy 10-year TIPS. And sometimes you will see TIPS with the same maturity dates, but different issue dates. So you might see two TIPS that mature in 2027, for example. And one of them might have been issued in 2007, and one might have been issued in 2017. And there might have been a third that was issued in 2022. So there's no standard rule. One simply goes to see what's available in the market. And the first question, I'm sorry.
The first question was, what if you don't hold these bonds until the maturity date?
Right. TIPS are traded on the bond markets, the public bond markets, just the way Treasury bonds are. Treasury bonds are said to be the most liquid market in the world. And TIPS are very liquid. We're going to talk about how market prices are set and how to interpret the market prices that you see. I've used the example of the Wall Street Journal. And when you sell a TIPS before it matures, it is quite likely that interest rates will be different than they were when you bought the TIPS or when the TIPS was issued. If interest rates are lower than they were when the TIPS was issued, then the price of the bond is likely to be higher than the adjusted face amount, which we talked about just a moment ago. If interest rates have risen, then the bond price will have fallen, and it will be likely lower than the adjusted principal amount. We have time for one or two more here, Carrie, and then we're going to move on.
Okay. Like I-bonds, is there a dollar limit per year?
There is no dollar limit. There is no dollar limit that you can hold. That the only limit is the size of your portfolio. And TIPS represent approximately 10% of the Treasury's outstanding. The TIPS market is very large.
Okay, well, we have more questions, but we can.
Well, we could do one more. We can do one more.
What are the key differences, other than the $10,000 limit, between I-bonds and TIPS?
One key difference is, and this is probably the largest one, that I-bonds have a fixed face amount, and the interest that's paid reflects inflation. But changes in interest rates do not change the face value or the trade at the market value of your I bonds. They're always, if you bought $10,000 worth, the face amount is $10,000 until they mature. The interest accumulates, but the face amount of the original bond stays the same. With TIPS, the value changes as real interest rates change, and so there's somewhat more principal risk associated with until they mature. There's principal risk, and so that's related to the question that we just answered, right? When somebody asked what happens if you sell your TIPS before it matures, you're taking risk that the interest rates changed and that the price therefore will be different than the adjusted face amount. Whereas with I bonds, that won't be true. Okay, very good. All right, so let's move on now, and we're going to talk about some more practicalities of TIPS. And I'm going to warn that some of these slides are somewhat technical, and there's a lot of numbers on them. I'm going to do my best to be clear about the main points and not focus too much on the details. Okay, so let's think about how TIPS market prices work, and this goes back to one of the questions that we answered just a couple of minutes ago when the person asked, what happens if I sell my TIPS before it matures? There is an active market in TIPS. If you go to the Wall Street Journal, for example, you can see, and this is an excerpt from the Wall Street Journal page of June 13th, 2022, and it lists every TIPS, and this shows 2 of them, and I think at this point there are some 30 or 40 TIPS outstanding with different maturity dates and different coupons. So let's look at some of the numbers and then interpret them a little bit. So here are 2 TIPS, and they're showing the maturity dates. This is February 15th, 2041 and February 15th, 2042. And we see then the coupon, the bid, the asked, the change, which we're going to ignore, and the yield. And the yield you'll see has a little asterisk around it, and that's reflected down here, and it says the yield to maturity on accrued principal. Okay, how do we interpret this? Well, the first thing to do, I think, is to look at the yield, and you see that the yield, this is a little less than 1%, and the coupon is 2%, 2.125%, 2 1/8. So the yield is much lower, and if we remember the discussion we had on bonds in the last webinar, when interest rates fall, prices rise. And in this case, we see that the price, and this is the bid and ask, is about 120. Now, 120 is another multiplier, and it's relative to 100. 100 would be par, or exactly equal to that adjusted principal amount. So if this yield was 2.125%, then these numbers would both be right around 100. But because interest rates have fallen, the bid is what, if we went to the market with a TIPS with a face amount of 100, somebody, and this coupon of 2.125 and a maturity of 2041, February 15th, 2041, the highest bid, the best bidder, is bidding 120.23. And by the way, this is not 0.23 meaning 23 hundredths, it's 20.23 meaning 23 30-seconds. And I'll talk more about that in just a moment. What I really want to focus on, though, is that 120 is bigger than 100, and 100 is par. If this number was 100, that would mean that the face amount on the bond is what the bond would transact at. Now, if we look at the 2042 bond, then we see that the yield is just about 1%. The coupon when the bond was issued was 0.75%. So interest rates have risen and the bond price is therefore lower than 100. So it's trading at about a 5% discount to the adjusted principal or the adjusted face amount. So what is that? How does that translate? Here we're looking at those same lines from the Wall Street Journal. Remember, we had the maturity and the coupon and the bid and the ask, and now we've added another column that's also in the journal. I was going to say in the paper, but I look at it online now, which is the accrued or inflation adjusted principal, and that is simply the adjusted face amount that we calculated at the very end of the last section. Remember when we had the CPI for April showing up for the 1st of July and the CPI for May showing up for the 1st of August. On the 13th of June in 2022, we were looking at March CPI going to April CPI. So that, when applied to the principal of this February 15th, 2041 bond, that adjusted principal is $1,316 for a $1,000 bond. That's what would be the face amount. But remember that this bond has an interest rate we saw that's lower than the coupon. So the bid and the ask are higher. And I've taken here the average of those two. So that's 120 and 25.5 30 seconds. And we divide that by 100, that gives us 1.208. We multiply times 1316 here, and that gives us the market price, which is $1,590. So because interest rates have fallen since this bond was issued, the price has risen. And in addition, inflation has risen. So the price has risen, there's a premium, inflation has risen, and there's an inflation adjustment to the face amount, and we get a market price that's almost $1,600 for a $1,000 bond. And the same thing is true, or the same approach applies for the next one, but remember this one's trading at a discount, right? So we've taken the average of these two to get 95 and 11.5 30 seconds. We divide by 100, that gives us 0.954. We multiply it times the inflation adjusted principal, which is 1,275, and that gives us 1,216. So notice that here, the 1,216 is less than the adjusted principal, and here the market price is greater than the adjusted principal because of the different ways that interest rates have changed since the issue dates of these two bonds. Now, you might ask, why are we talking about 30 seconds as opposed to hundredths? And the answer lies way back in bond history. And I'm just reminded, I had a great uncle who worked for the First National Bank of Chicago in 1932, around the time of the Great Depression. And I remember him telling me a story about how bonds were trading at low prices, and he talked about 30 seconds. And for whatever reason, bond prices are still not decimalized. So that's the way they're quoted, and that's the way they're reported in the journal. So to pull back for a second, we start with a TIPS. At issue, it's priced at 1,000. The face amount is 1,000, and that face amount adjusts for inflation. So if there's positive inflation, that face amount goes up. Then when we're thinking about that market price, we have to understand how real interest rates have changed since the bond was issued. If real interest rates have fallen, the fact that you've got a bond with a higher coupon is a good thing. People want that bond because they can't buy bonds like that anymore at issue. They have to buy them in the current market. And so they're going to pay a premium if interest rates have fallen. On the other hand, if interest rates have risen, then people prefer bonds with a higher coupon that they can get, and you're not going to get full face value for your bond. And so you're going to have to sell it at a discount. So to go back to the gentleman who asked the question, what happens if I sell my TIPS before it matures? There's your answer, in perhaps in more detail than you were looking for. Okay, so that's how TIPS are priced. Now let's think about how TIPS are taxed. And we're going to keep this very. I'm going to try to keep this at a high level. I've read several times the tax code on this. As you might imagine, it's many pages of very small print, and it is a cure for insomnia. I promise you. But we'll do our best to communicate what's going on. So for bonds that are held in a tax-deferred account, a retirement account, there's no special treatment. Interest is received, inflation adjustments occur, and they increase the face amount, and at maturity, the adjusted principal is returned, but they all add to the account balance, and that account balance is taxed on distribution, just the way any other bond or stock would be. For bonds that are held in taxable accounts, interest and inflation adjustments are taxable as federal ordinary income, but they're not taxable as state income. And positive inflation adjustments are called, for tax purposes, the original issue discount. And I am not prepared, please don't ask me why, I do not know. And those positive inflation adjustments are taxable in the year that they occur. If there's deflation, negative inflation adjustments are called deflation adjustments, and they reduce income as they arrive. So if you got a certain amount of interest and then the price was adjusted down, that adjustment down would be deducted from the interest that you received when you calculate your income for tax purposes. And then finally, if you buy a TIPS at a premium, then you can amortize that premium over the life of the bond, and you can reduce the income and then reduce the income that you're paying tax on. So let's look at an example here. And let's look at original issue discount first. This is the same bond, that 20-year TIPS of January 15th, 2006. And we're going to look at 2022 income in 2021. So we can look back at that TIPS and we can see what the index ratios were. And the adjusted principal at the end of 2021, and actually they tell you to use the first day of the next year, is $1,393. The adjusted principal at the end of 2021 was $1,311. So you get the difference between those two as the original issue discount, and that's $81.62. So that's going to be income for 2021. And by the way, you don't pay tax on this original issue discount twice. When the bond matures or when you sell it, you subtract the cumulative original issue discount that you've paid tax on from any capital gain for federal tax purposes. Okay, so now what about total income? So we have here the 8162 from the original issue discount. We also have $13.12 of interest that was paid in January of 21, and $13.50. I wrote here 1/1/22. This should actually be 7/15 of 21. Another $13.50, and so we add those together, and we get $108.24 of income. Now, as far as I'm concerned, this is one of the primary reasons to hold TIPS in a taxable account in a mutual fund. Keeping track of all of this stuff is bound to drive up your cost of tax compliance. But that's a sort of almost a by the way, because if you hold TIPS through mutual funds or ETFs, the manager will take care of this for you. I think it's important to recognize that this original issue discount and the taxation of it as ordinary income is a little bit of a disadvantage. If you were holding some other asset and there was inflation, it would be taxed, and you held the asset for more than a year, that inflation would be taxed as capital gain instead of as ordinary income. And having inflation taxed either as a capital gain or as ordinary income is a bad deal, right? Because you're being taxed on the in effect, you're being taxed again on the decline in purchasing power of the dollar, and that's just doesn't feel fair, does it? But that's the way the tax laws are written right now. So there is an advantage, though, to hold it from a tax perspective for holding TIPS in a retirement account as opposed to in a taxable account. Okay, so that's what I wanted to say about TIPS and how they work. And now let's, from a sort of a functional perspective, now let's talk about how well they do in protecting against inflation. Okay, so I recently read a book by a fellow named Antti Ilmanen. He called it Investing Amid Low Expected Returns. But one of the interesting things that he did was to talk about various asset classes and how they protect against inflation. And he's providing here a consensus view of, when I say consensus view, I mean a consensus of professional students of assets and their returns about how well various asset classes protect against inflation or how well they maintain their purchasing power. Stocks, maybe. The evidence is somewhat equivocal. Bonds, nominal bonds do not. Cash does not. TIPS do. Real estate does. And commodities do. Now, if inflation is stable, it may be built into nominal bond interest rates and savings account and CD interest rates. And so with stable inflation, bonds and cash can do reasonably well. But when there's surprise inflation, they don't do well. And checking accounts which have very low interest rates, you're almost always going to lose ground. You're almost always going to lose purchasing power to inflation. And you might say, well, if bonds and cash don't protect against inflation, why would I hold them? And the short answer is they don't have the risks of some of these other asset classes, stocks and commodities and real estate. So they're saying that you're going to sell bonds and buy stocks to protect against inflation. Stocks, first of all, are imperfectly correlated with inflation, and secondly, they're a lot riskier than bonds. So it's not clear that there's an advantage to doing that. And for safe assets, TIPS are really the only game in town in terms of protecting low risk assets against inflation. Now, I'm going to show you a couple of analyses that demonstrate that TIPS protect well against inflation, and I'm going to. They're somewhat technical, and so I'm going to show you what they are, and I'm going to suggest that they demonstrate that TIPS do well against surprise inflation. But I'm not going to spend a lot of time on the analytics here. So we're looking at a couple of analyses. The first analysis here is looking at current bond returns against current and future inflation, and we're looking at TIPS, the Bloomberg aggregate, and then short, intermediate, and long-term treasuries. and we're looking at how they correlate with inflation this quarter, inflation in the next quarter, inflation 2 quarters out, and inflation 3 quarters out. And the first thing I want you to notice is that TIPS are above the line. That is, they have a positive correlation with future inflation. And the other types of bonds have negative correlations with future inflation, right? So TIPS are forecasting inflation, and basically you're getting more return on TIPS when there's going to be inflation in the future. You get less return on bonds, and especially a lot less return on long-term bonds when there's inflation in the future. And a lot of these correlations are statistically significant. And the likely mechanism is that current bond returns are incorporating forecasts of future inflation. And that's bad for normal treasuries and for the aggregate, because purchasing power is going to decline and nominal interest rates are going to rise. And it's good for TIPS because purchasing power is maintained. Okay. Now, here we're looking at how a TIPS mutual fund, and this is the Vanguard TIPS mutual fund, and then again, they're Vanguard. It's a Vanguard mutual fund, not Vanguard TIPS, and how that compares to the performance of a mixture of Treasury bond mutual funds. These are iShares mutual funds, and I mixed them so that they would have the same duration or the same exposure to interest rate risk. And notice that, and this goes from 2002 to the present, notice that they're pretty closely tracking each other. And then right here, notice that the TIPS sort of forge ahead and the bonds lag behind. And that is, I think, fundamentally because of the response to surprise inflation. And then we can look at that very specifically on the next slide. And what we're looking at here is the difference in return between that TIPS fund and that combined Treasury fund with the same maturity, if you will, and then a forecast based on, or a line that's based on the correlation between inflation surprise and that difference. And inflation surprise, we calculated by looking at a forecast from that's captured by the Federal Reserve, and it's a year ahead forecast. So in January of 2020, they're forecasting inflation for January of 2021, and so forth. And what we've done here to estimate what the surprise is to take the actual inflation for that month or that quarter and subtract the forecast. So if actual inflation was larger than the forecast, we say that's a positive surprise. And if it was less than we say it was a negative surprise. And if there's a positive surprise, then the tendency is for TIPS to outperform treasuries. If it's a negative surprise, then there's a tendency for treasuries to outperform TIPS. Okay, so what this is saying is TIPS are protecting you against surprise inflation. Now, how does inflation affect financial plans, and how can TIPS help with that? And we're going to look quickly here at a sample lifetime balance sheet. This is all made up. There's no data here, and we've got resources on one side, and then we've got committed spending, and then we have the amount of sustainable spending or amount of spending that can be supported, how much we're spending, and the extra, the surplus. And notice that we have on the side here, we have a lot of assets that are, we think, not likely to be affected by inflation, but nominal bonds and cash will be negatively affected by inflation. If you look at the inflation impact on insurance premiums and other committed spending, the only thing that's affected here is mortgage payments, and I actually have this backwards. That the inflation impact will be favorable because you're going to repay the those mortgage payments in less expensive dollars. So that's advantageous. So the effect on your surplus is going to depend on the relationship, or whether there's a lot more cost in your nominal bonds and your cash than the benefit that you get from the mortgage payments. And to the extent that you replace your nominal bonds with TIPS, then you're likely to improve your ability to protect your whole plan against inflation. Now I'm going to skip a couple of slides here, and I'm going to come to my last point, which is that together, if you look at TIPS yields and Treasury yields, you get a forecast of inflation. So we can look at the yield on TIPS for 5 years out, 7 years, 10, 20, and 30, and we can look at the Treasury yields that are being paid now. We can see in the market what yields are on Treasury bonds and on TIPS for bonds with 5-year, 7-year, 10-year, 20, and 30-year maturities. And the difference between those two, remember that we said that the nominal rate of return equals the real rate plus inflation. So the future nominal rate is going to equal the future real rate plus future inflation. And so this is called break-even inflation here, and it is the difference between the Treasury yield and the TIPS yield. So if the TIPS yield and the nominal yield was the same, then there would be no forecast of inflation. But right now there's a substantial forecast of inflation. Out at 30 years, we're forecasting about 2.5%. 5 years, we're forecasting 3%. That's higher than it's been in some time. Okay, and I've run long, Carrie, so we can perhaps, if there are lots of questions, we could go over if need be.
Okay, yeah, there are quite a few. So here's a person who said he just placed an order for a 10-year TIPS on Treasury Direct, but it won't be processed until the auction next month. Is this always the case?
Yeah, well, if you buy TIPS at auction, they are issued at auction. They're issued on the date of the auction, and there you're going to get the same price as everybody else gets at issue. But okay, you can place bids in advance, but the bonds are not available until the auction closes.
Okay, right. What advice do you have about how to purchase TIPS in an individual account versus a retirement account?
I think I suggested that TIPS there's tax advantage to having the TIPS in a tax deferred account, a retirement account, relative to a taxable account. So if you have the choice between the two, then the retirement account is going to be the better choice.
Okay. This person is asking very specifically about the pros and cons of the Vanguard short-term TIPS fund, 2.5-year average maturity, versus a regular Vanguard TIPS fund where the maturity is usually around 8 years.
Right. They're two different mutual funds. The second one purchases TIPS in proportion to their share in the TIPS index, so basically in proportion to their share in the market. The short-term TIPS fund is going to invest in TIPS that are maturing as the person asking the question asks or suggests. The maturities are much shorter. So the short-term TIPS fund is going to be less responsive to changes in real interest rates. If real interest rates rise, the price will drop less. If real interest rates drop, the price will rise less. But on the other hand, you have more what's called reinvestment risk. So when the short-term, when the bonds in that short-term fund mature, they're going to buy more short-term bonds, and they'll just keep doing that. And so they're reinvesting more frequently than that long-term fund will. And so if interest rates are going up, then that short-term fund will get those bonds more quickly, if you will, than the longer-term one will. On the other hand, if rates are flat or down, or if they're fluctuating, then the longer-term fund will be less affected.
Okay. When you buy tips from the Treasury Direct, when do you start to see interest paid into your account?
The tips pay interest every 6 months. So they pay 6 months after issue, 12 months after issue, 18 months after issue, and so forth. So it's dependent upon the bond itself rather than the purchase date.
Okay. So have we passed the sweet spot to buy tips with interest rates going up now?
I never try to forecast where interest rates are going, first of all. If you are seeking inflation protection, tips provide it. And tips provide it from the day you buy, from the day you hold the bond. So the sweet spot is recognizable only in retrospect, right?
Mhm.
So we can know when interest rates were, when interest rates stopped rising rapidly enough so that the coupon would offset the decline in price that's associated with rising interest rates. So it's not knowable, unfortunately.
Right. Can tips be used to create a bonds ladder?
Absolutely, they can. I would emphasize that when one is creating a tips ladder, one should attempt to match the maturities of the bonds you are buying with the timing of spending that you intend to do. And if one is buying a tips ladder just to roll it over, so if you're going to buy a 10-year tips, and when it matures, then you're going to buy another 10-year tips, and when that matures, you're going to buy another 10-year tips, then I would buy a mutual fund instead. Because you're getting no advantage from doing that. The advantage to holding individual bonds is matching the date on which they mature to the spending that you want to do. And if there is no such match, then you're bearing a lot of interest rate risk associated with the change, or that would come out in the change in price of the individual tips or the mutual funds that you're holding to fund spending in that particular year.
Okay. Okay. What is your expectation for real rates in view of quantitative tightening?
I do not have an expectation. I think this is sort of my personal personal opinion. I believe that that there is no one that understands the inflation generating process, and I think we've seen that. I think that the sort of the traditional monetarist approach did not do well in 2007 to 2009. The sort of let's look at unemployment as a measure of slack in the economy, and if that one hasn't done well either. And I think that, and this is speaking as someone who studied macroeconomics in some depth and has a lot of empathy for macroeconomists. I just think that no one knows, and they're doing the best they can, but they're kind of trying to figure it out as they go along, because there is not a model that is universally accepted by there's no consensus model on how this works.
Am I correct in concluding that you pay income tax on OID, but don't actually receive the corresponding income?
You don't receive the income in cash, but the change in face value of the bond definitely occurs. So it is, some people say that you're paying tax on phantom income, right? That it's income that doesn't actually exist, but it is a change in the face value of the bond. That's a real thing, and the law is written so that you have to recognize that income or that change in face value in the year it occurs.
Okay. Okay, and then someone asked, and I want to answer this just so everyone knows, someone asked if we would share the recording, and yes, we always share the recordings of the webinars. Everyone who registered will get an email with a link to the recording of this webinar. So just to clear that up. I think that's just about all the questions we have.
Okay, excellent. So I've got one more slide with takeaways, and then we'll conclude.
Okay.
Okay, here we go. So inflation steals purchasing power from nominal assets like cash and traditional bonds. I say inflation is a thief. It is a very, I say it's a nasty thing. It's like a thief in the night. The purchasing power just goes. Real interest rates equal nominal rates minus inflation, as we saw early on. TIPS are inflation-protected Treasury bonds, so they are Treasury bonds, and they are protected or supported by the full faith and credit of the U.S. government. The TIPS face amount, each TIPS face amount adjusts for inflation with a 3-month lag, and TIPS pay interest on the inflation-adjusted face amount. If there's deflation, TIPS will preserve purchasing power and may do better. TIPS market prices reflect both inflation adjustment and changes in real interest rates. Both TIPS income and inflation adjustment are subject to federal tax in the year they occur. TIPS match Treasury performance if inflation is stable and outperform if inflation surprises. And together, TIPS and Treasury yields predict inflation. So thanks everyone for attending, and we will hope to see you at another Sensible Financial webinar soon.